TSS and BTE have joined forces.
Context,
Power.
edge.
The new paradigm of trading.
Imagine looking at a weather radar, right? You see a Category 5 hurricane heading straight for your house.
Yeah, total nightmare scenario.
Exactly. The barometer is plunging, the wind is howling, but then you look over at the town's official panic meter, and well, it's just sitting there at a perfectly calm zero.
Which is,
Yeah.
terrifying in its own way.
Right. It's this strange, unnerving disconnect. And that is exactly what the stock market looked like in mid-June of 2026. Welcome to our deep dive today. Our mission here is to unpack a really dense 4-day window of market notes from Spot Gamma specifically, like June 8th through June 11th.
Yeah, those 4 days are fascinating.
We really want to understand the hidden mechanics of why the market was whipping around so violently under the surface, while the overall volatility meters were seemingly broken.
Well, the time frame we're looking at is critical because the market was digesting an almost unprecedented pileup of catalysts. I mean, we're not just analyzing one isolated shock here.
No, not at all.
We're looking at a market absorbing a massive confluence of events, all while the dealer positioning was remarkably fragile.
Yeah, the lineup over this specific 10-day stretch was genuinely absurd.
Just to map it out for you listening,
Yeah.
we had a highly anticipated CPI print, massive headline risks, including escalations with Iran, breaking news about Trump actively investing in AI companies.
Or get Oracle.
Right, an Oracle earnings report, an FOMC rate decision, a massive options expiration, and, looming over everything like the Death Star, the giant June 12th SpaceX IPO. Okay, so let's unpack this.
To do that effectively, I think we have to ignore the surface-level price action for a moment. We need to look at the underlying dealer positioning.
Makes sense. Mechanics under the hood.
Exactly. I mean, the news headlines were the catalyst, sure, but the options data, specifically the gamma levels and the resulting hedging requirements, that tells us how the market was actually structured to absorb those catalysts.
Right.
This is a story about what happens mechanically when institutional money starts abruptly shifting its bets in a highly illiquid environment. So before we get to the massive breakdown on Wednesday, June 10th, we need to look at the vulnerability that was building up on, June 8th and 9th.
The foundation was already cracking.
Yeah, because coming out of a sharp drop the previous Friday, the Spot Gamma data showed something that really caught me off guard.
Yeah.
You'd think traders would be panicking, but they weren't aggressively bidding up puts or bracing for an immediate crash.
No, they were engaged in what the notes called crushing call prices.
Right, crushing call prices.
Yeah.
What does that actually look like in practice?
So that phrase refers to a rapid deflation of implied volatility on the upside. We saw institutions selling off their long calls and taking profits, which aggressively compresses the premium in those upside strikes.
So they're just cashing out the winning lottery tickets.
It's essentially, yeah. It indicates exhaustion rather than outright panic.
Yeah.
The market had simply, run out of buyers willing to pay top dollar for upside exposure.
But there were still bids underneath the market. I mean, the dip buyers hadn't completely vanished yet. The data points to a very specific narrative, keeping those bids alive early in the week. We had persistent headlines about Trump making government-level AI investments paired with NVIDIA's Jensen Huang doing his usual media tour.
Right, touting new product lines, claiming AI valuations were still cheap.
Exactly. And just to be clear for everyone listening, the market treats political figures purely as objective momentum drivers. There's no bias there, it's just raw data. But those headlines provided just enough liquidity to keep the surface relatively calm.
Which is a perfect example of a transient fundamental catalyst, right? It was temporarily masking a structural deterioration underneath.
Masking the rot, basically.
Yeah, exactly. Because underneath, the critical support levels were absolutely shifting. Entering the week, Spot Gamma had their risk pivot on the S&P 500 pegged at 7,490.
Okay.
But by June 8th, based on shifting open interest, they officially revised that pivot down to 7,390.
Wait, hold on. Let's talk about this risk pivot concept for a second.
Yeah.
Because it often gets treated like some magical arbitrary line on a chart.
It's definitely not arbitrary.
Right, so is a 100-point drop in the risk pivot just a psychological line in the sand where day traders get spooked? Or is there an actual physical mechanism forcing the market's hand at 7,390?
Oh, it is entirely mechanical. The risk pivot represents the dividing line between positive and negative gamma for options dealers.
The trapdoor.
Exactly. When the S&P is trading above 7,390, dealers are generally long gamma. In that environment, their delta hedging requires them to sell into rallies and buy into dips.
So they're stabilizing things.
Right. Their activity acts as a shock absorber. It suppresses volatility.
But if we drop below 7,390,
The polarity reverses completely. Dealers flip to short gamma. In a negative gamma regime, their hedging requirements force them to trade with the prevailing trend.
oh wow, so they had to join the momentum.
Yes. As the market drops, the puts they are short gain delta really rapidly. So to remain delta neutral, dealers are forced to aggressively short S&P futures.
Wait, so their mandatory hedging actively accelerates the downward momentum.
You got it. It creates an avalanche effect where the selling itself generates more selling.
That is wild. So falling below 7,390 isn't just a bearish signal on a chart. It triggers an institutional feedback loop,
Exactly.
which really makes the behavior of the smart money leading up to that drop incredibly telling. Because you have this fragile foundation, right? And right before the CPI data hits, we see a massive, deliberate rotation out of tech.
Yeah, it's almost as if they were setting up the dominoes before the catalyst even arrived.
The rotation was so stark. If you look at the flow data from June 9th and 10th, capital wasn't just exiting the market broadly, it was highly targeted.
Very precise. Semiconductors, which are tracked by the SMH ETF, were breaking down aggressively. I mean, they sliced right through a massive open interest cluster, their 595 hedge wall.
And that capital didn't just disappear, it immediately flooded into consumer defensive. The data highlights Walmart acting like an absolute fortress while semiconductors bled out.
Yeah, Walmart was a rock.
It bounced hard off its 118 hedge wall and actually closed above 120. Institutional managers were literally dumping high beta AI darlings and hiding their cash in big box retail.
And what's fascinating here is that the options flow leading up to that rotation signaled the move days in advance.
Right, the flow patrol stuff.
Yeah, Spot Gamma's Flow Patrol isolated two incredibly specific trades that demonstrated how institutions were positioning for this exact regime shift. The first one was a massive bearish position on the semiconductors.
The 25,000 contracts on SMH, I remember seeing that.
Exactly. Someone came in and swept roughly 25,000 contracts of far out of the money SMH puts. They were specifically targeting the 530 and 550 strikes for the June 12th expiration.
And if you were buying 25,000 deep out of the money puts that expire in a matter of days, you are paying a massive premium for a very specific, aggressive tail risk hedge.
Right. You're not just casually speculating.
You are betting on an immediate, violent contraction in tech. You aren't doing that unless your internal models are screaming that the sector structural support is gone.
And, well, that downside bet paid off exponentially when SMH broke that 595 support. But the flow data also captured where the selective upside bets were being placed.
Yeah, tell us about the Amphenol trade, because that was crazy.
Right, Amphenol, ticker APH. Back in May, someone established a brilliant swing trade. They bought 2,550 lots of calls when the underlying was around $122.
Okay.
By the time this June 10th rotation hit, APH had rallied to $154. The premium on those calls expanded from $10 to $30.
So they tripled their capital in under a month.
Pretty much.
But looking at the SMH put sweep and the Walmart rotation, it begs a massive question about intent.
How so?
Well, if you manage a large fund, the colossal SpaceX IPO is hitting the market on June 12th. Are these managers aggressively dumping tech just to free up billions in cash to participate in Elon's new offering? Or is this rotation driven by genuine terror regarding the geopolitical setup and that negative gamma trapdoor?
I mean, the data suggests it's really a compounding effect of both.
Like a perfect storm.
Exactly. The liquidity requirements for the SpaceX IPO are forcing managers to liquidate their most profitable, highly correlated tech winners.
Right. You sell what you can sell, not what you want to sell.
Exactly. But they are executing those liquidations in a market environment that has zero shock absorbers left. They're withdrawing liquidity precisely when the geopolitical landscape requires the most stability.
Which brings us to the spark that finally ignited all this dry tinder. Wednesday, Juneteenth. The morning starts with a CPI print, and it's actually soft.
Which is what everyone wanted.
Right. It's the inflation data the market theoretically wanted. But the S&P barely has time to digest the macroeconomic data before the geopolitical shock hits the tape. Trump signals a severe escalation regarding Iran, and crude oil immediately spikes.
And this is where we see the physical mechanics of the risk pivot play out in real time.
Yeah. The trapdoor opens, the S&P 500 attempts to rally on the CPI data, hits that 7,390 risk pivot level, and is just violently rejected.
It was brutal.
It wasn't a slow bleed. The index plummeted 169 basis points, closing near the absolute lows at 7,267. We plunged straight into that negative gamma avalanche you described earlier.
Yeah, and when you look at the intraday data from that session, the dealer hedging activity is staggering. Spot Gamma uses this metric called HIRO hedging implied risk options.
Which tracks the real-time stuff, right?
Exactly. It tracks the real-time delta impact of options trades on the underlying equities. So on June 10th, the HIRO indicator didn't just drift lower, it showed two massive concentrated waves of aggressive bearish flow.
Like panic selling.
Yeah, one wave hit at 10:30 a.m. and the second hit at 2:00 p.m.
The slope of the HIRO chart over those windows was incredibly steep, too. I remember the notes pointing that out. It wasn't just a general slow sell-off.
Right, and the steep negative slope is the critical detail. It tells us that market participants weren't just passively letting their calls expire. They were furiously bidding up puts while aggressively shorting longer-dated calls.
Then that forces the dealer's hands again.
Exactly. That intense demand for downside protection forces dealers to short the underlying equities even harder, which just compounds the negative slope of the HIRO indicator.
That panic bidding for protection produced a statistic in the Juneteenth notes that is honestly hard to wrap your head around. The S&P 0DTE straddle the at-the-money straddle expiring that exact same day spiked to $74.
Yeah. That's 1.01% of the total index value.
Which is an astronomical premium for an intraday derivative.
Yeah.
I want to pause on the math of that for a second so everyone listening really gets it.
Please do.
If you are paying $74 for an S&P 0DTE straddle, you need the entire index to move more than 1% in a single day just to break even on the trade.
Just to scratch the trade.
That means dealers aren't just pricing in a little bit of turbulence. They are actively pricing in extreme multi-standard deviation tail risk. The notes mentioned it was the highest price for that specific straddle since late 2025.
Which is crazy. If we connect this to the bigger picture, the options market was mathematically confirming the instability of operating below 7,300. When dealers price a daily straddle at 1%, they are explicitly telling you that the structural shock absorbers are completely gone. They are demanding a massive premium to take the other side of your trade because they know their own delta hedging is about to violently whip the underlying index around.
So we fall into this negative gamma zone. The market gets absolutely hammered on Wednesday. Then we wake up on Thursday morning, June 11th. We're trading under 7,300.
The trapdoor is fully open.
Right. The SpaceX IPO is less than 24 hours away. Crude is elevated because of the Iran news. By all conventional logic, the market should be in full-blown panic mode. The VIX should be screaming past 35 or 40.
But it wasn't.
No. The data highlights this wild paradox. The VIX is just casually hovering around 20. Like if we are deep in negative gamma with major macro and geopolitical risks actively on the table, how on earth is the VIX only at 20?
That is the million-dollar question. And the answer lies in the correlation math of the index itself. Spot Gamma tracks this using a visual called the compass map.
Okay, the compass map.
Yeah. If you looked at that map a week prior, almost every major index constituent was clustered tightly together in the same quadrant. They all had highly elevated implied volatility on the call side.
So everyone was betting the same way.
Exactly.
Yeah.
The market was operating under a consensus call positioning. Everyone was positioned for the exact same directional outcome.
High correlation. They were moving as a monolith.
But by Thursday, June 11th, that map had completely shattered. The individual stocks were scattered across every single quadrant. Spot Gamma refers to this as dispersed volatility.
Meaning the underlying stocks were still highly volatile, but they were moving in completely different directions.
Right, exactly the opposite of a monolith. You had semiconductors tanking, consumer defensive names like Walmart rallying, energy stocks spiking on the Iran news, and tech names completely paralyzed.
And because they offset each other.
Yes. Because the VIX measures the implied volatility of the index as a whole, it relies heavily on implied correlation. When constituents are highly dispersed and offsetting each other's movements, the aggregate index volatility is mathematically suppressed. The fear wasn't unified, so the VIX remained artificially low at 20.
Which feels like a massive trap. Like
Yeah.
if you are managing a portfolio and you just look at the VIX, you might think, oh, 20 isn't that bad. Things are relatively calm.
But it's an illusion.
Right. The spot gamma notes argue that a VIX of 20 in a dispersed negative gamma environment is actually the most dangerous setup possible. Because the VIX isn't rich yet. It has what they call easy room to expand.
It has a ton of room. If a macro shock hits, say, a definitive military escalation in the Middle East, that dispersion vanishes instantly. The correlation goes to 1.
Everything drops together.
Exactly. Everything drops together. And because the VIX is starting from a compressed base of 20, it has the capacity to violently double in a matter of hours.
And this creates a complete paralysis for volatility sellers, doesn't it? I mean, in a normal market cycle, when you get a sharp drop and a spike in fear, institutional volatility sellers step in.
Right. They provide the floor.
They short the expensive options, which forces dealers to buy the underlying equities to hedge, and that mechanical buying triggers the rally. But sitting here on June 11th, nobody wants to step in.
No one in their right mind. This raises an important question about risk management. You cannot safely deploy short volatility strategies when the known unknowns are this severe.
It's just too risky.
Selling volatility the day before the largest IPO of the decade, while geopolitical tensions are actively breaking on the newswire, that is suicidal risk management. The market is effectively frozen. The natural buyers are sidelined, waiting for clarity.
So we step back and look at the entire board over these 4 days. The sequence of events is incredibly clear.
It really paints a picture.
It does. The market exhausted its upside momentum, crushing its own call premiums. Smart money saw the vulnerability and secretly rotated capital out of semiconductors and into defensive names like Walmart.
The dominoes were set.
Then, the dual spark of the CPI print and the Iran headlines hit a market that had already lowered its risk pivot. We fell through 7,390, triggered the negative gamma avalanche, and now we are sitting in the dark, with individual stocks whipping around but the VIX mathematically suppressed at 20, completely paralyzed.
Which leaves us staring directly at the June 12th SpaceX IPO.
The giant vacuum cleaner.
Exactly. And the spot gamma notes highlighted a really fascinating structural quirk regarding how this IPO is going to interact with the broader market mechanics we just discussed.
You're talking about the index inclusion delay, right?
Yes. Major index providers like NASDAQ and the Russell are not scheduled to add SpaceX to their benchmarks until 5 to 15 days after the stock begins trading.
Wow. Up to 2 weeks.
Yeah. Furthermore, the S&P 500 committee explicitly declined to grant an early inclusion waiver.
But the demand is obviously still there. I mean, the notes point out there are roughly 21 different SpaceX-adjacent or aerospace ETFs launching simultaneously, and all of them are mandated to acquire the stock immediately.
Right. So consider the mechanics of that liquidity draw. You have a multi-billion-dollar entity entering the public market. Massive active ETFs and institutional funds are required to allocate capital to it immediately.
But the passive index funds are structurally barred from buying it for up to 2 weeks.
Exactly. So where does the money come from?
The capital has to come from active liquidation of other assets.
Precisely.
And in a market that is already completely drained of liquidity, trapped in negative gamma, and teetering on a geopolitical edge, what happens to the rest of the equity market when a vacuum cleaner the size of SpaceX turns on?
That's the terrifying part.
Right. To buy the new stock, institutions have to sell the rest of their portfolio into a market where dealers are already aggressively shorting. That is the ultimate stress test for an already fragile system.
It's going to be a wild ride.
It really is. Thank you all for joining us on this deep dive into the underlying mechanics of the market. Keep questioning the headlines, respect the dealer positioning, and we will see you next time.